How much income can you have in retirement and not pay any income taxes, maybe even not file a tax return? I've got those details and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Are you pursuing what should be all of our dreams, and that is not to pay any tax at all, have income, and be able to have the right lifestyle and not pay any tax? That would be fantastic. Well, it's a reality for many, for many in retirement. And it doesn't mean that you've got to be, destitute. In fact, in retirement, there are certain criteria we're going to go over here in just a second where, you might not need to file a tax return and might not need to file any taxes. So how does that work? Well, at a high level, the U.S. tax code is the most complicated on the planet. It's termed a progressive tax system, and that's not a political term. It's just that sort of it builds. Okay, so essentially how the system works is you add up all of your income, and then yes, some is treated differently, capital gains or tax exempt interest, but aside from those nuances, you add up all your income. You get a standard deduction. Everyone, just for being you get a deduction. So if your income's below that deduction, then there you have it. You don't have to pay any taxes. But if you do have income remaining after that sort of universal or standard deduction, then the first chunk of that income is taxed at 10%. The next chunk, if you have more than that threshold, is taxed at 12%. If you have more than that threshold, it's taxed at 22%, more than that 24%, and so on. So that's why they call it progressive, okay? So some people pay 0% tax because their income doesn't exceed that standard deduction. Others, their income does exceed that standard deduction, but they stay within the 10%. That's not many, but a lot of people then push through and stay within that 12%. So the first chunk is taxed at 10, but then any spillover is taxed at 12. Then if you have more than that, spillover is taxed at 22, and so on. So it's sort of like a waterfall, cascading, okay? So that's how the tax system works. In retirement, though, you have your income sources are sort of they're sort of tighter, and you're on a fixed income, if you will, depending on your situation. So what would the scenario be? How much income could you have where you don't have to pay any taxes at all? Well, it all depends on Social Security. And Social Security, the way it's taxed is very, very unique. You need to know that originally it was never supposed to be taxed. This is after-tax money to begin with, right? So you're paying into the Social Security system through FICA. FICA is not a deduction. You're having the income tax that you're paying for FICA is after-tax money. And then yet, when you receive that money back to you in the form of Social Security, you've got to report it as tax if you qualify. If your circumstances align, you have to report it back as taxable income. It's a complete sham, but anyway, so it all depends on Social Security. Social Security is taxable, or it's included as taxable income if all of your income sources plus half of your Social Security exceeds certain levels. For a single tax filer, if all of your other income, so dividends, interest, capital gains, IRA withdrawals, part-time work, those sorts of things, all of your other income plus half your Social Security, if that calculation is $25,000 or higher, then you have to start including some of your Social Security on your tax return as taxable income. If that exceeds, somewhere around $32,000, then more and more of, and it's really, that's part of the calculation. It's really not. Once it exceeds $25,000, some of your Social Security starts being added to your tax return. But the higher that number is, that calculation, the more and more and more of Social Security lands on your tax return until ultimately, if that calculation, all of your income plus half of your Social Security, if it's so high, if that number is so big, then the majority of your Social Security is taxable. 85% of it lands on your tax return. That's for single. For married filing jointly, then you add up all of your other income plus half your Social Security. And if that exceeds $32,000, then some of your Social Security starts becoming taxable. And if that number exceeds, as it continues to get higher, more and more and more of your Social Security becomes taxable until 85% of it is. It's a very confusing system. Basically means that if you qualify, if your circumstances are where some of your Social Security is going to be taxable, you can't do your taxes by hand. You need a software, someone to do that calculation for you to determine how much of Social Security is taxable. And then the other thing, it obviously means that the more income you have, if once you start required minimum distributions, or if you sell a property that has capital gains, or you take more out of your IRA to buy a car or something like that, it's going to have a significant impact on your taxes because it could mean a lot more of your Social Security becomes taxable. So essentially it comes down to this. If your only income sources in retirement is Social Security, then you're not going to pay any tax, essentially. Okay, if that's it, you're not going to have to pay any tax. If your only income sources are such that all of that income plus half your Social Security is below $25,000 or below $32,000 if you're married filing jointly, you're not going to pay any tax. And then if that calculation is such that all of your other income plus half your Social Security is just a little bit above, and it depends on your overall situation, that's where you'll want to work with the CFP and work with the CPA and take a look. But if that calculation exceeds $25,000 or $32,000 if you're married filing jointly, but not by that much, meaning if some of your Social Security starts landing on your return, but not a lot of it, then likely because the standard deduction grew so much a couple of years ago, then even if you have a little bit of your Social Security land on your tax return, most likely you're not going to have to pay any tax. Your standard deduction is going to wipe out all of your income, okay? It is just that when you reach that threshold where all of your income plus half of your Social Security is enough where half of your Social Security starts landing as taxable or more, that's when, well, you're likely that's going to mean more income than your standard deduction and you're going to have to pay tax. So it's not an exact number. I mean, if all of your income is Social Security, then you don't have to pay any tax. If all of your income plus half of your Social Security is below $25,000 for single or $32,000 for married filing jointly, then yeah, you're not going to have to pay any tax. So those are the income thresholds. But even if you're above that, but just slightly, then it's very common and very likely you won't have to pay any tax at all. So does that mean you can stop filing a tax return altogether? Possibly. Possibly work with your CPA on that and your CFP, but essentially you've got to be age 65, okay? You've got to be age 65, and then if all of your income is from Social Security, then you don't need to worry about it. You don't need to file a tax return at all. If not all of your income is from Social Security and you're age 65, then there's certain income thresholds, and I've got those on the screen now. You can take a look depending on your situation and see, well, do you qualify? Are you eligible or not? But you've got to be aware, okay, if this means that you don't really need to file a federal tax return, if you had any taxes withheld from other income sources, you're going to need to file a tax return to get get that withholding back, right? And you should probably update your withholdings to make sure you don't have any withholdings anymore. And also just know that, well, if in the past that you met this criteria and you didn't need to file a return, if you draw more out of your IRA or all of a sudden have more income, you might have not needed to file one in the past and you'll need to file one this upcoming year. And if you're hot and cold, if that's every other year to you, then I would just continue to file so that you're not missing out on anything. And then the last thing that I would caution you on, if you're kind of 65 or older and you reach that threshold where you say, based on these figures, I don't need to file a return, you might still need to file a state return. And you can't file a state return if you don't have a federal return. In Indiana, where our headquarters is, that's where I live, Social Security is not taxable, but your other income sources would be, your adjusted gross income does land over and kind of fall over onto your state return, and you get a couple deductions, but it's not a lot. Certainly not as high as the standard deduction that you get on the federal return. So we see a lot of times where someone from a federal standpoint doesn't need to file a tax return, but they still need to for their state, and therefore you need to file a federal return in order to file the state return, and it's sort of, the two systems aren't working completely in sync, and so therefore you still need to file a return. So whether that's for you or whether it's for your folks that you're trying to help out, those are some of the rules, but essentially the hope would be, and the plan could be, that if you have all of your other income sources are not taxable, meaning Roth IRA or just withdrawals out of basis from an investment account or out of cash, and then Social Security, you might be in a situation where you're not needing to pay any federal tax, and hopefully, ideally, any state tax as well, which would be a fantastic position to still have enough income, still be able to meet all your obligations and everything, and live the life that you want, but not pay any tax. Work with your certified financial planner. Proactively planning along the way can make it such that less and less of your Social Security becomes taxable, and this is more and more likely. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.